My name is Pete Kresser, and I am the National Account Manager that handles the RPAG relationship. At Nationwide, we protect people, businesses, and futures with extraordinary care. And today we've got Gail Braddock presenting to you. And Gail is part of our advanced consulting group that is an extension of the Nationwide Retirement Institute, which provides that practical thought leadership through timely insights and education, client-ready tools, and consultative support. Again, thank you to all the members for your valued partnership, and I look forward to meeting some of you next month at the RPAG National Conference. So I'll go ahead and turn it over to Gail. Gail, take it away.
Hi, thank you, Peter, and thank you everyone for having me here. Good morning or afternoon. I'm on the East Coast, so I'm seeing it as afternoon, but good morning to everyone, and thank you for having me. So as you can see, we are going to talk about problems that business owners have, primarily related to retirement planning, and solutions that can help business owners plan for their own retirement as well as their employees' retirement. We've also got a couple of other bonuses at the end. We're going to talk about planning for the premature death of a key person and ways to reward top executives. So with that, I am going to give you a minute to read this important disclosure. Neither Nationwide nor I are providing legal or tax advice. This is educational or informational only. So as I mentioned, we are going to talk about retirement solutions. We're going to spend just a short amount of time on tax qualified retirement plans because that's what you do, and you've got a great understanding of that, but we will spend a little more time on other types of ways that business owners as well as their employees can plan for their retirement, such as non-qualified deferred compensation. Then we'll talk about the insurance-based income solution. And then, as I said, we'll switch gears for some other common problems that business owners have and ways to provide solutions to them with dealing with the key person, as well as providing employee benefits to tie top executives to the company. So first, tax qualified retirement plans. And of course, we all know that tax qualified retirement plans are very good, and they are generally the first and best resource that business owners should visit before they decide what they are going to do for their own retirement. They are very unique in that they have many advantages. They have tax deductible contributions, and of course, any earnings on those contributions remain tax deferred until they take the money out, and the contributions are deductible to the employee, and the employer doesn't have to pay income tax at the contributions when they go in. They reduce the taxable income of business owners, whether they're pass-through business owners or whether they're W-2 employees of a corporation. Of course, reducing the taxable income of anyone who participates in a qualified plan. We've got that tax deferred growth and assets or monies that are contributed to a qualified plan are going to be secure from creditors, which is very important. So generally, we are going to recommend that when talking about retirement with business owners, the first thing that they do is look at the options that they have with qualified plans. Of course, they're good, but we do have downsides to them. What I hear, and I work primarily with non-qualified executive benefits. We have a team here, and we have members of the team who work on qualified plans and non-qualified plans, and I'm primarily a non-qualified person. So what I hear when I get the phone call is the contribution limits are too low for a qualified plan. We've got that qualified plan, but we want to be able to contribute more for our retirement. So what I hear on my end is that's usually the number one objection. Is the plans are great, but they're limited to how much highly compensated individuals can put away. Because of course, maximizing your retirement plan for someone who makes $500,000, they get the same limit as someone who makes $100,000, and yet they probably have different retirement expectations as to the style that they're going to retire. Of course, We also have all the ERISA requirements. We've got participation, funding, vesting, reporting, and disclosure rules that must be complied with. If we do have pass-through owners that are getting that qualified business income deduction, that may reduce the deduction that they are able to take. And a tax qualified plan is going to require annual maintenance costs. It's going to take a TPA. So it is not going to be necessarily a cheap thing to implement. So there are disadvantages to qualified plans. So why would employers look at not using a qualified plan, or a qualified plan not working for them as their only or best retirement plan? Well, as I mentioned, we've got those administrative costs. Also, as you know, there can be testing failure with the highly compensated individuals may not even be able to put away their limit if we have got testing failure with the highly compensated people. Also, they may have eligibility issues, they may have high turnover, low paid employees, and of course, certain qualified plans like Simples are going to require contributions, whether it is a good year or a bad year. So these are all things to consider when implementing a qualified plan. So of course, the first alternative is a traditional IRA. And traditional IRAs, again, they're good, but it's going to be very limited to who can actually do them, and the deduction limits are pretty low. So as you know, a business owner or any individual can deduct up to $6,500 or $7,500 if they're 50 or older. But they really, a lot of times, can't even really participate in an IRA because it will be partially or fully non-deductible once their modified adjusted gross income is over $116,000. Roth IRAs are another great alternative. We've got those limitations, and we've got the inability for many people to actually be able to put anything into the Roth IRA. So now we're going to move into non-qualified deferred compensation plans. So you see here on this slide, we have this big circle here that says no tax advantage for owner of business. That's an important thing to keep in mind and remember, because it is the case. And again, as a non-qualified person with my advanced consulting team, the number one call I get is I can't contribute, or I have a business owner who can't contribute as much as the business owner would like to their qualified plan. They want to set up a non-qualified deferred compensation plan for themselves. Well, in any kind of pass-through, so you see here we've got sole proprietorship, partnership, S corporation, or an LLC that is taxed like any of these. In any kind of pass-through, there is no tax advantage for a business owner to implement a non-qualified deferred compensation plan for himself or herself. So why is that? Well, the way that non-qualified deferred compensation works is a plan is not subject to the ERISA requirements like a qualified plan is, but the trade-off to that is that they're not going to get the special protections and the special blessing of the non-includability on the employee side and the deduction on the employer side that qualified plans get. So while a participant in a qualified plan can put in any amount to a non-qualified plan that up to reasonable compensation and up to the amount the plan allows, and there are not contribution limits for a business owner, it doesn't work, and there are trade-offs. So, as I mentioned, with a non-qualified plan, when, let's say we've got an employee of the company and the employee makes $300,000, says, I want to defer $50,000, so this year I am only going to pay tax on $250,000. That's great. They do get that deferral. They're deferring that $50,000. But instead of that $50,000 going into a trust that is set aside for them that $50,000 remains a general asset of the company, the employer company, available to the creditors of the employer company, and the employer does not get a deduction. So you can see how that would work with a business owner who is the owner of an S corporation or a proprietorship or a partnership or LLC taxes, any of those. When they pay taxes, they may get a W-2 as an employee. They probably do get a W-2 as an employee. But at the end of the year, any net income of the business that hasn't been distributed out shows up on their K-1. So they also pay tax at the individual level on their share of the income of the business that's not distributed out in any other way. So in that case, whatever, if we've got a business owner and his K-1, his W-2 goes from 300 to 250, his K-1 is going to go up 50. So there's no tax advantage for business owners. It does work very well, however, for employees. That's the purpose of a non-qualified deferred compensation plan, is to benefit highly valued employees, to recruit, retain, and reward those highly valued employees that we want to keep tied to the company, as well as help them put away more for retirement, get a current tax deduction now, get that tax deferral on the funds saved for their retirement, and be able to augment their retirement in the future. So that person making $300,000 a year may be able to retire on a little more than someone who's making less, but able to contribute the same amount to the qualified plan. So I'm talking about pass-throughs here. What about C corporations? Well, unfortunately, by and large, then a non-qualified deferred comp plan is not going to work for a C corporation shareholder. It will work for employees, again, in the same context that I said. That's what they're designed for. Now, if you have a minority shareholder in a C corporation, it could work. But for any shareholder in a C corporation who has control of the stock, of the voting rights, they could be deemed to have constructive receipt of any asset that is set aside in that plan. In other words, even though they've signed an agreement saying that we're going to defer this, if they control the company, you know, he's deferring this $50,000. If he ever needs that $50,000, he can just take it. He's not really deferring it. He's not really giving any control, because he controls the company and he controls how much he can take of the company. So that substantial risk of forfeiture that is required in order to be able to defer that income is not there. So typically when we're talking about non-qualified deferred compensation, whether we've got a pass-through or a C corporation, in most cases, the answer is not going to work for a business owner, can be excellent for compensated executives that the business wishes to reward and retain. I have presentations only on non-qualified deferred comp. We can't really get into all of the nuts and bolts of that here, especially as it's not really going to be an option for business owners. But as I said, it can be an excellent way for many people to save for retirement, just not business owners. So what other ways are there? Well, of course, we can look at our other savings, other ways to save, you know, basically what we would call after tax. You know, look at CDs, you can look at mutual funds, you can look at real estate collectibles. Of course, deferred annuities, you get some deferral up front, but they're still purchased with dollars. So all of these assets are assets that the individual would take post-tax money after they paid tax on it, and then invest and set aside for retirement or whatever need they have. So other than the deferred annuities, for they're going to be paying income tax not only on the investment before they invest it, so they're going to invest the post-tax amount, they're also going to be taxed on the income as it's earned. With CDs, obviously, they're going to pay tax on the interest every year. Mutual funds, stocks and bonds, they may get dividends, capital gains distributions, capital gains when they sell stock, real estate. So they're going to be taxed as they trade or as they earn income on these assets. Again, deferred annuities are a little bit different. They can defer, they use their after-tax dollars to purchase the annuity, but they can defer the income on that annuity until they are ready to turn on that income stream, at which point they will be taxed. And at that point, they're going to be taxed at ordinary income tax rates. So what else is there that we can look at that's tax advantaged? Well, when I get calls, and I get these calls from the business owners who want to set aside money for retirement, can't really do the non-qualified deferred comp plan, we often wind up talking about the insurance-based income solution, or IBIS as we call it. I always think of a bird, it's not a bird, but with IBIS, they do have the ability to get some tax advantages by saving for retirement in a maximum funded cash value life insurance. So what is IBIS? Again, the insurance-based income solution. It is not a life insurance policy in and of itself. It is a strategy that can be used with a cash value life policy. It can be a variable policy, can be an index policy. It's going to be a policy that is designed to maximize cash value growth and minimize death benefit. Now, there is going to be a death benefit that is income tax free. So there is the advantage that we've got this death benefit in the event of premature death that's income tax free, but it also can provide tax free income. So when the business owner or other individual pays a premium into a policy, that policy is going to grow cash value, and that cash value growth on an annual basis is not taxed on an annual basis. So when you've got stocks, bonds, mutual funds, you're going to have annual taxation on any income you have to report. Not the case with a cash value life insurance policy. And if they are able to have enough time frame to grow that cash value, which generally we structure these so that that is going to be the case at retirement, 15, 20 years later, they can start taking distributions from the policy that are income tax free. That is because a life policy is taxed on the FIFO basis, first in, first out. So that means that all the premiums are going to come out first when the individual takes out withdrawals from the policy. So the premiums come out first, there's no income taxation. And then they switch to policy loans once they get to the point of gaining the policy. So there's still no income taxation, even after they pull out all their bases. So this can be an excellent retirement supplement to a qualified plan, and very helpful for business owners who really can't use the non-qualified deferred comp plan. So who would be good for the IBIS situation? Well, as I said, there's a death benefit. So we have to look at someone who needs life insurance. They do go through underwriting. So there has to be a death benefit need, although in this case, there is a death benefit need, but it may not be as important to the individual as being able to save on a tax preferred basis. Because it's insurance, as I said, they're going to have to go through underwriting. So they're looking at insurability. They need to be able to fund the cash, have the cash flow to fund the policy. So usually we structure these so that the premium payment period is only over a limited amount of time, because of course what we want to do is contribute during the working years and pull money out at retirement. So we may pay premium for 10 years or 15 years. So it's got to be somebody who can afford to fund that policy for that period of time. They want those that tax deferral that I about. And we're also looking at probably someone who's already maxed out the qualified plans. I keep saying the qualified plan, at least looking at what qualified plan options there are, the first and best thing to look at. But if they've maxed out that qualified plan or explored all their qualified plan options, then we might look at supplementing that income with the IBIS. So we've talked about multiple savings opportunities here for business owners as well as their employees. We've looked very briefly at tax qualified plans and IRAs. We've also looked at non-qualified plans and determined that they're really not going to be an option for the owners, although they can be an excellent option for the top employees. Other assets, after-tax assets, as well as the insurance-based income solution. One thing I didn't mention here that oftentimes business owners think about as a retirement source is the business itself. Many business owners are thinking, well, my retirement plan is my business. I'm going to sell the business and I am going to use that income for my retirement. Again, this is a whole nother seminar, but you should always, when you're talking with the business owners about retirement options, look at their business succession plan. Do they have a business succession plan in place? Is a buy sell something they need to look at too? Because sometimes the business owner may be relying on a value that isn't there or they're not going to get if they haven't planned in advance for the succession of that business to get the value out for their retirement. So I mentioned that we were going to discuss a couple other things. We're going to look at the loss of a key person. So we've got business owners. Retirement, of course, is not the only consideration. I mean, realistically, they're probably not thinking about retirement till you get them to start thinking about retirement. But when you start talking with them about non-qualified deferred compensation and who they would want to benefit, then those same people that they want to recruit, retain, reward, keep in the company that are very critical of the company, there could be a definite need in the event that those people were to prematurely die. You could think about that if a key person were to prematurely die, there may be a need to replace lost earnings so that person had a bunch of relationships accounts that would not stay with the business. So replacing that lost revenue, maintaining the business credit position, providing a financial cushion for the business, having the financial wherewithal to have the time to recruit and look for a replacement, offsetting lost value to the business, as well as if there have been any survivor payments required, or that the business owner has promised any survivor payments to the individual. Key person insurance, that is a policy that is owned by the business, can help fulfill all those needs. So let's look at how this works. So we have this key individual, and as I mentioned, any individual that the business owner feels is important enough to talk about a non-qualified deferred compensation plan for may be a key person who needs to be looking at key person insurance. We have the business here, and so the business is going to be the owner and pay the premium on a life insurance policy that is on the key person. So does the key person have any interest in the policy? No, they are the insured. Now, they do have to, under IRS rules, they do have to consent to the business owning the policy on themselves, but the primary purpose of this is to replace lost income to the business for the loss of this key person. So the business also has, if they use a permanent policy, they also have the cash value of that policy. So what policy would they use in this? I will say that either term or permanent can work depending on the situation. So term policies, of course, are very expensive and the premiums are much lower, but they're just a death benefit for a certain amount of time. And after that time has passed, if the person hasn't passed away, there's nothing left. So if you have a valued executive and the business, they say they're in their 50s or so, and the business knows, okay, they're probably going to be here maybe 15, 20 more years, and there's not a need to have any cash value. If there's only a death benefit need, then term makes perfect sense, and it costs less money, and it's certainly probably the appropriate product to use at that time. Or a permanent policy could be used if there's going to be other uses for that cash value, such as there is a non-qualified deferred compensation plan in place, and the business is going to use that cash value to meet that liability down the road. So that really just depends on whatever the case is. It's a case-by-case basis. So this is what it is during the key person's lifetime. And then at death, the business is going to be the beneficiary of that policy, and they are going to get the death benefit from the insurance company. It's that simple. But this is often something that should be discussed in conjunction with benefiting top employees. So what else for top employees? Executive bonus is another way to benefit those top employees that the business owner wishes to keep around or encourage to come, such as in recruiting. So an executive bonus plan is a way to reward a non-owner employee. Notice again, I said non-owner employee. So why did I say non-owner? Because for the owner would just simply pay himself more. He's not really necessarily trying to retain himself. So while a bonus is paying the employee more, it's paying the employee more via paying a premium on a personally owned permanent life insurance policy that the employee owns on himself. Okay, why is this retention then? The retention is the policy needs premium to keep going, at least for a certain amount of time. You know, I said we could structure it as a policy that's not paid for forever, but it needs premium to keep going. So if the individual were to leave, then the business is no longer going to pay the premiums on that policy. So then they have to look at whether they want to use their own money to keep it going or let it lapse. We also can put more strings on an executive bonus plan. We can put a restrictive endorsement. We can limit the executive's access to the cash value of the policy during a period of time. We can even require a repayment of bonuses. That's going to be called a REBA, a restrictive endorsement benefit arrangement. But right now we're just talking about executive bonus, which you also may have heard this referred to as 162 bonus. Section 162, that's the IRS code section. That's the same thing. It's 162 executive bonus. So as I mentioned, the key executive is going to own the policy. They're going to be insured. They're going to name the beneficiary of the policy, and the business is going to pay the premium on that policy as long as that person is employed by the business. So why would we do an executive bonus plan? Well, it provides a meaningful benefit. You say, okay, well, cash is a meaningful benefit, and it is. Cash is a meaningful benefit. But again, this life insurance is more long-term than cash. They can't just go out and just spend it right away. It's something that is long-term that requires the business's participation long-term. Very simple to understand and administer. It only took a couple slides. It's very easy to understand and administer. It's easy for the business owner to understand. It's easy for the executives to understand. Less expensive than other benefits, of course. That's because it's so simple to administer. We're not going to need a TPA here. We're just looking at paying for a fringe benefit. The employer can choose the participants. Of course, that's very important to the employers because we're, again, looking at most likely only benefiting the top executives that the employer values the most and would lose the most if they were to leave. And unlike the non-qualified deferred comp plan, the business is going to get a current income tax deduction. So remember when I said in my description of the non-qualified deferred comp plan, employee defers $50,000. He made $300, he defers 50, his W-2 says 250, so he's paying less tax. Company doesn't get a deduction for that 50. In the bonus situation, if the company is paying the employee $250,000 income and then paying $50,000 on a premium for a policy that employee owns and names the beneficiaries of and has all of the rights and benefits to, then there will be a current income tax deduction for the employer at that time. So while that is not necessarily the most important reason for structuring a bonus plan, it is something that many times business owners like to hear, as opposed to I have to wait in a non-qualified deferred comp plan, I have to wait for my deduction down the road. I appreciate all the time that you've given me this afternoon, and thank you so much for being here.